So did you sell late in the day on Thursday? You know, when St. Louis Fed President James Bullard talked about raising interest rates another 50 basis points? Well, if you didn't sell, don't jump out of a first floor window just yet. Watch the rest of this video to find out why. By the way, James Bullard has been talking about raising rates more than the rest of the Fed for quite a while, so why the big reaction this time? The markets are funny. They don't always act the way you think they should act. Right now, the markets aren't screaming, "Get out of the way." So don't listen to those doomsday, tea leaf reading technical analysts who are saying the end of the world is coming. Let's slow down. Let's take a more sane look at what's going on in the markets right now to see if there's really any cause for concern. So let's start out as we always do and take a look at how the markets have been acting over the past few days, past month, past 6 months, and past 5 years. So if we look at this chart from last week, a week ago on February 10th, you can see the markets were in a very unhealthy state. ARK, the purple line, the riskiest investments here, finished dead last, followed by small caps, followed by the NASDAQ, followed by the S&P, and the Dow was actually slightly up. This is a very unhealthy looking stock market. But what happened this past week? Well, if we look at this past week, you have exactly the opposite. Now, even though ARK has pulled back in the last couple of days, you can see that it's well ahead of the small caps, NASDAQ, S&P, and the Dow. So this is a very healthy looking stock market, even though there was a pullback here at the end. And what about over the last month? Well, this looks great too. Look at this. ARK Invest up the highest, followed by the NASDAQ, followed by small caps and S&P 500, and finally in dead last, the safe haven stocks in the Dow Jones Industrial Average. Love it. And what about over the past 6 months? This is an interesting picture because this actually shows an unhealthy rally attempt and a healthy rally attempt. Let's take a look. So if we look at this recent rally, the bottom was here, and if we draw a line up to here, you can see the slope of ARK Invest. Pretty good. Well, now let's take a look at the slope of the NASDAQ 100 from this bottom point. And it has less slope, so it's not going up as fast. And I'm going to skip small caps because there's just too many things in here. It gets kind of noisy. But let's look at the S&P 500. So if we draw a line here, you can see that has even less slope than the NASDAQ did. And now let's finally look at the Dow Jones Industrial Average. The Dow Jones Industrial Average has almost no slope. So this is a very healthy rally off of the bottom. You can see the highest risk stocks are going up fast. The next highest risk stocks are going up pretty fast. The next lowest risk stocks are going up more slowly, and the safest stocks are barely going up at all. This is very, very healthy. So back in October, though, we had an unhealthy rally attempt. So let's take a look at that, and let's go the same order again. So I'm going to start with the most risky stock. So the market kind of bottomed out here. Let's call it here, and it tried to rally here. So let's put this about here, just for the heck of it. And then let's take a look at the NASDAQ. And what do we get here? We get something like this, pretty anemic. And then we'll look at the S&P 500. And the small caps pretty much followed this as well. So you can see the slopes here. But what happens when we look at the Dow? Well, when we look at the Dow had the highest slope here of all of these. That's a very unhealthy attempt at a rally. And I'm sure I said this in my videos back then, that this was not a healthy rally attempt. So you can tell a lot just by looking at these graphs. And what about over the past 5 years? Well, you can see if we look over a longer period of time, the highest risk stocks, ARK Invest, really got trashed here. So right now they're at the bottom of this pile. But if this market continues to recover, they will pass up all of these other ones. And you can see the NASDAQ, the next riskiest bucket of stocks, is outperforming the S&P, which is outperforming the Dow and small caps. So over the long term, this is a somewhat healthy rally. ARK had a lot of problems here and is coming in last right now, but things won't stay that way. Eventually, ARK will pass these others up. And we had an interesting thing happen today with the bottom dynamics. Earlier in the day, actually, we had a bottom forming indicator here. This orange line was actually up here earlier in the day before the markets turned higher at the end of the day. And you can see what happened, ended up falling instead of staying up here. Now, when it was up here, we had a bottom forming indicator. But if you look at this, what bottom, right? We peaked out here and we've only come down this far. If that's the bottom, I'm okay with it. That's not bad at all. And what about risk versus opportunity? Nothing to see here, guys. I mean, look at this. The risk level in red is down here. Yes, it's going up recently, but it's still at what, 35? I mean, I don't start to worry about the markets until this line gets up near or above 80. Then I'm worried, but not down here at 35. And look at the risk acceleration. You can see how it dropped back here, right around where the market's bottomed. And it stayed low, and you can see that the market's rallied. Well, look where it is today. It's down here almost at 10. This is crazy low. This is crazy low risk. So I am not overly concerned right now with what's going on in the markets. There's still a lot of health in these markets, and you'll see that as we go through some of the other indicators. Now, equity versus safety isn't one of those. You can see the cash is ranked number one. We definitely don't want to see that. But I think that's in response to the gyrations that the market's been going through. Yes, there's been some pullback. So cash and T-bills have kind of moved up here. But you can see that equities are still in a healthy relationship here with small caps in the NASDAQ 100 ranked near the top, and SPY and the Dow ranked down here. This is a fairly healthy looking equity market. I would just like to see cash falling down here. You can see that we definitely have an unhealthy Treasury market with long-term treasuries down here at the bottom. Now, if we go way back here, you can see we had a healthy Treasury market with long-term treasuries ranked above cash and shorter-term treasuries, and equities were very healthy back here on the 27th of January, but that's not the case right now. So this doesn't necessarily give us a good look, but remember, each one of these is a piece of the puzzle. You can't hang your hat on any one. You've got to look at the whole picture, and right now, I think the whole picture is saying, let's wait and see what happens. We're not going down a rat hole yet. What about buying and selling pressure? I'm going to go over these fairly quickly, but you can see the Dow ran up here, fell back, and then started to try and rally again, but it's basically kind of consolidating and going sideways here. And the buying and selling pressure isn't giving you very many clues here either, just kind of noodling along. Let's take a look at the S&P 500. Very similar picture, although the buying pressure was much stronger back here as this began to rally and go higher. But just like the Dow, you can see that it's kind of going sideways to down here. And what about the NASDAQ 100? Very similar picture, very strong buying pressure back here, and now we're just kind of noodling along, going sideways, going nowhere. And Russell 2000, this was one of the early rally groups with a very strong buying pressure here. And again, we're just kind of going sideways and consolidating. And Ark Innovation, similar picture, very strong rally here, up from less than 30 to almost 45 from here to the peak. That's a heck of a run with very strong buying pressure here. And now, again, we're just kind of going sideways. Not good or bad. Maybe this is a good thing. The market just kind of has to catch its breath while everybody looks around and goes, oh my God, everything went up so quickly. What do I do now? Well, we'll find out. Let's take a look at sector rankings because I think these tell another piece of the story and a very important piece. So what you want to see here is, and I explained this in my last video, the risk level of each one of these sectors is up here on this top row. So obviously green cash is the safest investment as long as you're not considering inflation risk. And treasuries are just a little bit more risky. And then you have gold, and I put that at 50% because I don't know how to call that. It's not correlated to anything. And then, you've got things like the Dow Jones Industrial Average, which is orange. I've got that at 30. The S&P 500 at 20, and the NASDAQ 100 at 10. So the NASDAQ 100 is clearly more risky than the S&P, which is more risky than the Dow. And then if we look at ARK Invest, I have that at 0 because that's more risky than all of these. So you can see by the colors here, the risk associated with each one of these sectors. And then if we look at how they're currently ranked, though, you see all the red ones are up here. This tells me there's a very healthy appetite for risk right now. Investors are piling into the risk assets and not the safe assets. This is a very good look for the market. Now, consumer discretionary is still just below staples, consumer staples. This wasn't the case a couple of days ago, but since the market pulled back, they kind of flipped again. But let's see what happens when we look at how these rankings are accelerating. So let's go to the next screen. So now if we look at the sector acceleration rankings, this tells us how quickly these are moving. And you can see here that consumer discretionary is way above consumer staples. So consumer discretionary is accelerating up in the ranks here, while consumer staples is down here. Cash has moved up a little bit here, along with treasuries, because the markets have been a little riled lately. But you can still see that the riskiest sectors are still up here in the top. Innovation, Ark Innovation, ranked at number 1. Emerging companies, 2. Technology, 3. And we don't want to put colors on there. You've got emerging markets, technology, clean energy. We got Bitcoin up here. This is a very, very healthy risk appetite. I am not concerned at this point in time. And how do treasuries look? Well, if we look a week ago on February 10th, you can see we had a rally attempt here, but overall the markets finished in a very unhealthy way for the treasury markets. Now, you could certainly see that in equity versus safety, where the longer duration equities were down at the bottom of the list. And that's what we're seeing here a week ago. And what are we seeing this week? Well, a similar picture. They continued to fall, and you can see the longest duration treasuries are down here at the bottom. You can see they're trying to move up here just in this last day. This is just today. So we'll see where this goes. And if we look at the buying and selling pressure, no surprise here. You can see how this rallied. These intermediate treasuries rallied. They flat topped, and now they're pulling back. And you can see that the selling pressure is above the buying pressure. What about 7 to 10 year intermediate to long treasuries? Very similar picture, nice rally, sideways, and now we're going down. And you can see that the selling pressure and the buying pressure have been kind of trading places here, off and on. What about long bonds, 20-year treasury bonds? Well, you can see again, rally, sideways, and now down. And you can see the selling pressure, the orange solid line, is well above the buying pressure. This does not look healthy for treasuries right now. And what about gold? Well, if we look at gold, had a very nice rally, flat top just like about everything else, and then it's been kind of pulling back here. And finally, what about Bitcoin? Now, this is one of the highest risk assets that investors can invest in today. And you can see it had a very nice run up here, went sideways, pulled back, but it's starting to rally again. This has been looking really good lately, and I hope this portends the appetite for risk for equities going into next week and maybe the week after, but there's no telling. We'll just have to wait and see how this plays out. As you can see from the previous analysis, the markets are really kind of stuck in a holding pattern right now. They're like a sail just kind of flapping in the breeze. It's untethered and the boat's going nowhere. And that's scary, right? Eventually, this has to break out one way or the other. And we'll have to wait and see what happens. But right now, based on everything I see, it's not time to turn tail and run yet. The markets still have a fairly healthy appetite for risk. It's just not showing up in the closing numbers yet. As I keep saying, my advice is to stay put until the metrics that I've been showing earlier in these videos really degrade to a point where there's cause for concern. We're not there yet. So for right now, buckle up your seatbelt because we could be in for a really nice lightning storm before a beautiful sunrise. Oh, that was corny. I'm Calvin Rose, and thank you for watching Invest Smarter today. That's all for now.